Welcome to a descent into the abyss of human greed and gullibility. These are the top three financial schemes in history. Fasten your seatbelt. Let's start with the godfather of financial fraud, Charles Ponzi, a name that has become synonymous with deception and greed. The year was 1919, and America was thirsty for unrealistic financial returns. The country was recovering from World War One, and people were eager to invest in anything that promised quick and substantial profits. Enter Charles Ponzi, a man with a plan that was about to leave a lot of people with empty stomachs. He was charismatic, persuasive, and had a knack for making the impossible seem plausible. Ponzi's scheme was simple and utterly doomed from the start. Yet, it was so enticing that it drew in thousands of eager investors. He promised investors ludicrous returns on international postal reply coupons. These were essentially prepaid stamps that could be exchanged internationally. Ponzi claimed he could exploit price differences in these coupons between countries and make everyone rich. He painted a picture of endless wealth, convincing people that they were on the brink of financial freedom. Of course, there was a catch. The entire operation was built on a foundation of lies and deceit. Ponzi wasn't actually investing in these coupons. In reality, he had no intention of making good on his promises. He was using money from new investors to pay off earlier investors, creating the illusion of massive profits. This tactic is now known as a Ponzi scheme, named after the man who perfected it. For a while, the scheme flourished. People were seeing returns and spreading the word, which only attracted more investors. People were throwing money at Ponzi faster than he could say arbitrage. The frenzy was palpable, and the excitement was contagious. But like all terrible things, it couldn't last forever. The cracks in the facade began to show. The more investors Ponzi attracted, the more money he needed to keep the illusion going. It was a vicious cycle that was bound to collapse. Investigations revealed the truth, and the whole thing came crashing down. The authorities caught up with Ponzi, and his empire of lies crumbled. Investors lost millions, Ponzi went to prison, and the term Ponzi scheme was forever etched in financial infamy. It serves as a cautionary tale of greed, deception, and the perils of too-good-to-be-true investments. Fast forward a few decades to the energy sector and Enron, a company that would become infamous for its deceptive practices. On the surface, Enron was the darling of Wall Street, a shining example of corporate success. Its stock price was soaring, its executives were hailed as visionaries, and its accounting practices were creative, to say the least. Enron's success was built on lies, deceit, and accounting loopholes that masked its true financial health. They used special purpose entities to hide billions of dollars in debt, creating a facade of profitability. For a while, the markets bought it, and investors were none the wiser. Enron's stock price continued to climb, fueled by hype and greed, as more and more people bought into the illusion. But in 2001, the jig was up. The truth could no longer be hidden. Enron declared bankruptcy, its executives were charged with fraud, and the company became synonymous with corporate greed and corruption. The fallout was massive, leading to stricter accounting regulations and a re-evaluation of corporate governance. Lesson learned: if a company's profits seem too good to be true, they probably are. Always dig deeper and question the numbers. And now for the grand finale, Bernie Madoff, the man behind one of the most infamous financial frauds in history. Madoff's scheme was a classic Ponzi scheme, but on a scale that was unprecedented and shocking. For over 2 decades, he ran an investment firm that promised steady, above-average returns, luring in countless investors. People trusted Madoff, a Wall Street veteran and former chairman of the Nasdaq stock market, believing in his reputation and expertise. But behind the facade of success and trust, Madoff was orchestrating a sophisticated operation of lies and deception, fooling even the most seasoned investors. He fabricated trading records and created fake account statements, making it appear as though his firm was thriving. For years, Madoff kept the scheme going, using money from new investors to pay off older ones, maintaining the illusion of profitability. But in 2008, as the global financial crisis took hold and investors began to withdraw their funds, the scheme collapsed under its own weight. Madoff was arrested, charged with 11 federal felonies, and ultimately sentenced to 150 years in prison, marking the end of his fraudulent empire. The Madoff scandal highlighted the critical importance of due diligence and skepticism in the financial world. It served as a stark reminder that even the most trusted individuals can be capable of extraordinary deception, leaving a lasting impact on the financial industry and its regulations. So, there you have it. Three of the most infamous financial schemes in history. These stories remind us that greed and deception can have devastating consequences. By educating ourselves, being wary of promises that seem too good to be true, we can help prevent future scams. Remember, if it sounds too good to be true, it probably is.